Look at what you are seeing here regarding non-busyness debt loans and liability levels, and you have to ask yourself why corporations are seemingly doing so well. Well, the answer is simple but hidden in plain sight. They are doing it because, as you can see, they are fueling their operations with borrowed money. Whether you are a government, a massive corporation, or just an individual trying to make ends meet, it all works the same way in the end. And, those big tech companies that we always thought were sitting on piles of cash, well, they have been quietly taking on more debt just to fund themselves and push their growth strategies forward. Now, what you are looking at here is what is happening in the interest rate environment. Remember, bonds or debt are guided by interest rates, and I need to show you something that is actually quite concerning. I am sorry to be the bearer of bad news, but the 2-year, the 10-year, and the 30-year yields have all broken out. Can you see that? Technically, what that means is that interest rates are more than likely going higher, and investors are demanding to be paid more for the level of risk they are actually taking. This is not good news with all of that debt that needs to roll over and all of that new debt that needs to be taken on at these significantly higher rates. This, my friends, is probably the single most important chart that I am showing you today because it is proof that we are in deep trouble. All of this debt is coming home to roost, and the consequences are happening right now, so yes, they may be partying on the stock market like it is 1999, but this is an early warning signal that the markets are not having it. The bond vigilantes are back, and how does that impact consumer sentiment? Well, inflation means that people have to spend more just to maintain their current standard of living, and the level of inflation is now so high that many have to borrow in 4 easy payments just to feed their family. That does not make them feel confident in the future. But hey, there you go, there is your tale of two cities, and it is really obvious because what is holding this together is consumer confidence. But do not worry, because look at the earnings. These corporations are making more money than ever. Yes, inflation benefits them because they pass the costs on to you, but surprise us, inflation officially rose 3.8% in April, eroding people's paychecks. That is the consumer price index. That is the inflation, and that is the official number. Do you really think that is the real number? Because I do not really think that is real. They have rigged things so that it looks better, but quite honestly, since 2021, and really since 1913, by design, U.S. wages never truly keep up with inflation. Nominal wages maybe, but in real terms, average workers are losing ground every single day. And this is extremely important because Main Street does not live from asset appreciation. The 1%ers do, but Main Street does not. And if you look at that bottom purple line there, after inflation, the real average hourly earnings, is it any wonder that people are suffering? Because frankly, by design, when inflation rises faster than wages, living standards begin to decline, or individuals take on more debt to accommodate the gap. And to be honest with you, inflation pressures seem to be escalating to me. What do you think? Here is the producer price index, the wholesale inflation numbers. These have not yet trickled through to you entirely. But producer prices matter because businesses eventually pass many of these higher costs onto the consumer, and they have to protect their profits. But that means inflation pressures can continue building underneath the surface of the economy, and we cannot see it yet because it is still in the producer price index that will come down eventually. But look at this. This 6% print has triggered a very important pattern shift. Let me show you what I mean. There you go. This chart shows producer prices breaking out just like those interest rates were breaking out to the highest level ever. This is important because commodities sit near the beginning of the economic chain, and they can hide a lot of ills with paper prices until they simply cannot anymore. Because when raw material costs rise, those higher prices have to move, and where do they move through? Manufacturing, transportation, food, every single aspect of the global economy. And that is why I say this is all just heating up. But this is a very big deal because this is another breakout, and it creates even more pressure on households, and it is definitely reducing your purchasing power. And at the same time, higher interest rates mean that the bond vigilantes are beginning to notice this inflation risk, just like I showed you. But what about the craziness happening in the gold and silver markets? Because all of you are asking, why is not gold rising? Why is not silver rising? Well, we are looking at the spot contracts. But let us take a look at this because a stronger than expected rise in consumer and producer prices raises concerns that the Fed may need to increase interest rates in the short term. Okay, so while I know that people watch the spot gold and silver market and think that truly represents the value, it is understandable because that is what we were taught. But like inflation, the paper market's dictating the price is all by design as well, and they admit it. It is not me just saying it or pulling it from some random site you read. When they set things up and they admit that all of this is by design, and even though that is in the process of shifting, we have been talking about that for almost a year and a half now. Wall Street logic is this: why would you hold gold? It does not pay interest. Bonds are better. Well, gold does not have to pay interest because it runs no counterparty risk. It is the single safest thing that you can do according to the Bank for International Settlements, which is the biggest bank. It is the central banker's central bank in the world. So in theory, bonds or debt are more attractive for investors than gold and silver because bonds pay interest, But I would like to ask you this little question. This is my $10 trillion Zimbabwe note. If I had a bunch of this debt and it paid me a bunch of this, can you tell me what good this would do? Because frankly, a trillion times zero is still zero. So let us look at what is happening on the technicals, because these are contracts and you can kind of see a wedge forming here. This is just a one-year contract. Now, I would like to point out to you that it is substantially higher. The silver spot contract is substantially higher today than it was just 1 year ago. And if you recall in our conversations, I said there are a few things that can happen. And one of them that is happening is that the spot silver contract is staying inside of that narrow range, giving that 200-day moving average an opportunity to catch up. But look, it is still 18% above that 200-day moving average. That does not mean overvalued, it does mean overbought, because they can create as many contracts as they want without limitations. So it does not reflect the true fundamental value of an ounce of silver, but last week I showed you how during this period of volatility, some very large players are standing for delivery on those silver contracts. So let us take a look at it, because that is what you are looking at. This is the 6-month silver contract. Now you can see there is a lot less silver for delivery out there. Okay, but in the meantime, silver prices are more volatile because they are telling you that there is a major shift going on. Here is the technical chart on gold, the 1-year spot contract. Again, I will point out that it is substantially higher than it was just 1 year ago, and we are still 5% above the 200-day moving average, which means that the spot gold contract is no longer overbought. But you can see how it is sitting, and it is creating that wedge, like a wedge of cheese, and we will see if it breaks out above or below. And all of this is just from paper contracts, not the real stuff in both gold or silver. And remember, everywhere around the world, the global central banks are accumulating gold. This is the 6-month COMEX gold. Can you see that somebody is taking delivery? Somebody is taking delivery even with the price pullback. And I cannot tell you exactly what those contracts are because I did not put that data in there. But is all of this volatility about keeping you away from buying gold because ETFs and technology demand physical buyers? This tells us that it is a structural trend, not just a short-term trade around the world. Retail investors were drawn to gold S-price momentum and safe haven, appeal driving bar, and coin demand up 42% year on year. So I want you to keep this in mind, that those paper contracts are one thing. But bar and coin demand is up 42% year on year. Demand in China surged 67% year on year, considerably higher than the previous quarterly record. And by the way, do you really think these central banks are going to be honest with us about what they are really accumulating? Because other Eastern markets, including India, South Korea, and Japan, also saw an increase in bar and coin buying, contributing to the ongoing structural shift in gold demand. Bar and coin demand was also supported by strong growth in the US and Europe, up 14% and 50% respectively. Can you see the difference between the contracts in the physical markets? You and I are not working in the contracts because they do not mean anything. That is all counterparty risk, but we live in the real world, and what you are looking at here is that bar and coin investor demand. So I want to begin with the tale of two cities. Again, we began with that, and let us just take it to conclusion. Today, I believe there is not one doubt in my mind that we are living through a tale of two economies. Wall Street experiences asset inflation and they party. Main Street experiences life inflation and they suffer. And what is really interesting to me in this is that in my generation, we were taught to accumulate assets, and frankly, those assets saved me. Thank goodness I had them. There were times in my life when if I did not have them to sell to feed my children or handle other circumstances, what would I have done? But these new generations that are coming up have been taught to collect experiences. Well, you cannot liquidate an experience if you get into trouble. You can leverage that experience for other things, but one side of the economy benefits from using those financial assets. The other side struggles with rising everyday cost expenses and that pesky inflation that impacts that declining purchasing power. And as debt rises, inflation pressures continue and confidence weakens more. More people are turning back. This happens every time to physical gold and silver because in the end, real wealth is not measured by how high a market can rise. That can mean absolutely nothing. Real wealth is measured by security in food, water, energy, security, barterability, wealth preservation, community, what we are doing here, and shelter. And so that is why I love these conversations, because I get to spend them with you. And you guys are what makes me feel really wealthy. And so now we will take some questions. David asks, how do I go about creating a local barter system using silver if our government imposes a CBDC or some other cryptocurrency system which can track every financial transaction? Well, when you are bartering, and there is more to that. But let me just do one at a time. You are bartering outside of the system, so the CBDC would not even come into account for that. Like, for example, if you were to come to my farm and you were to work, you give me a day S labor, you are going to walk home with probably eggs and whatever else we have that we are harvesting at that point. Well, that is bartering. I am bartering for your labor. It is not going through the financial system. Now, if you work for me and I write you a paycheck, that one is going through the financial system, but the bartering on a local basis, that is not going through the financial system. So that is how you find a group of like-minded people. That is why I say go to a farmer S market. Go to a community garden, get to know who grows your food, give them a day, labor, create that relationship, and now you are bartering, and that is outside of the system. That is why you have to have security in all of those areas, because if you don't T, you will have no options and you will be a slave. What this does in your possession is it buys you freedom, because everything is not going to evaporate. And by the way, too, it is one of the reasons why I like the pre-1933 gold, because it is in a different category. I do not want monetary gold. Monetary gold is what they screw with all the time and they can take away. This is not classified the same way. I mean, it was money. This was a $20 gold piece that was used, but it is outside of that system. That is what gives me a higher level of comfort, because I saw my Uncle Al accumulate at least 3,000 ounces of gold when it was illegal to hold more than 5. But he was doing it perfectly legally with this. Number 2, if every transaction will be tracked under a CBDC type system, what is the exit ramp for our precious metals without the government being aware of the transaction? If we allow that there is nothing you are going to be able to do other than local bartering. There is no privacy, that is what I can say. And look at what they have been doing for a very long time, is getting us used to giving up all of our privacy. So yeah, that is not okay with me.